I was watching the findings of the Royal Commission, and I was so incensed by, you know what? Do you know what really annoyed me? Is you have a very few people talking about Australians as if they just don't matter. Going, yes, we think it's best for Australians to have to pay a fee to a broker. I just thought, hang on a second. 60% of Australian borrowers now choose to use a mortgage broker.
Yeah.
And that has grown year on year on year on year on year. And what you're essentially saying, Mr. Hayne, CBA, is that most Australians are idiots. They don't know what's good for them.
Welcome to the Get Invested podcast, where we share great conversations with experts from all walks of life to uncover their secret know-how and where they invest their time, their skills and their money, and the benefits that this has created. You see, the truth is that everyone invests. Every minute of every day, we're investing our time, our skills, our energy and our money in something. Some of us are investing consciously, some unconsciously, sometimes for good, sometimes for bad, and sometimes for no impact. Get Invested will help you to start living by design, not by default. I'm going to help you to make it happen, not let it happen. You will hear the top tips on how you can live with conscious intent so that you can live more, work less, and leave a living legacy by investing now. Listen to the show to discover the top tips on how to get started, make the most of your investment journey, and ultimately to be living your dream, not someone else's. More episodes can be found on iTunes or at bushymartin.com.au/get invested. Thanks for listening, and now let's get invested. Hi, Freedom Fighters. Are you overhearing about the Royal Commission on just about anything and everything at the moment? It seems you just can't turn on the TV, radio, or open a newspaper without hearing about some form of horror story that's unfolding on a Royal Commission. There's currently Royal Commissions on the aged, on abuse, on disability, and banking. And if you're a bit cynical, you might be excused for thinking that they're all one and the same thing, with just the names changed to protect the not-so-innocent. Now, in our world that has gone mad with political correctness, it seems that if the politicians are in doubt, then don't make a decision, just call a Royal Commission. That way, you can be seen to be doing something without actually doing anything. You get good press, and you have someone else to blame for making the hard calls. So you can then play a variant of the old game of bad cop, good cop, or in this case, bad commissioner, good government. It has the sound and smell of an episode of the old comedy Yes Minister, where the intended target of the Royal Commission calls for one, so it can then influence the brief and the outcome. The government of the day then spends millions of taxpayers' dollars being seen to do something about a very small, unrepresentative part of an issue, milks it for as much media exposure as possible, and then the final report recommends wholesale, ill-considered and knee-jerk changes that target the most unrelated and defenceless scapegoat. It seems it's a bit like combining a game of blind man's buff with pin the tail on the donkey. And if the reality wasn't so serious, it'd be almost laughable. Now, I understand why all of this Royal Commission palaver might be making your eyes glaze over and your mind go to sleep. And perhaps this is the real intention, so that everyday Aussies are so numb to the noise that major impacts on you and your family can just slip through almost unnoticed. Because the sad thing is, the repercussions of implementing the Royal Commission recommendations have the potential to negatively affect every Australian in a big way if we don't all do something about it now. What do I mean by this? Well, let's take the case of the recent Banking Royal Commission on misconduct. Now, we all applaud the call to stamp out shonky behaviour by banks. And we all heard the horror stories about the big banks, like the Commonwealth Bank, in their fees for no service scandal, where they continue to charge the dead for a decade after they passed away, or where they sold worthless junk insurance that customers couldn't even claim on, or their fantastic efforts in continuously increasing credit card limits by thousands of dollars for a declared gambler. Seriously, no wonder no one trusts the big banks. However, we need to look at this in context, because according to reliable sources, misconduct in the banking and financial services sector represents less than 1% of the total transactions. Yet, wholesale changes are being recommended that will negatively impact on the entire 100%. Now, it feels a bit like wanting to make global decisions on the future of the world's oceans based on swimming in your backyard septic tank. Yeah, Bushy, I can hear you say, but is any of this really going to affect me? Well, sadly, yes, and potentially in a significantly bad way. While you would expect the Royal Commission to be making recommendations that produce better consumer outcomes by encouraging competition, sadly, the opposite now appears to be the case. And according to today's special guest, if the Royal Commission recommendations are all implemented, there's strong potential that everyone's home values would drop, that home loan costs in terms of repayments, rates and fees will all go up substantially, and it'll be much harder to get a loan, so housing affordability will fall. There's also strong potential that many competitive smaller banks and brokers just won't survive, which all plays back into the greedy hands of the big banks who caused all of the problems in the first place. Now, varying the common saying, I've always operated on the basis that if it ain't brokered, then you don't need to fix it. And to continue with some really bad mixed metaphors, it all looks like the small banks and the brokers are being thrown out with the bathwater. Yep, it's sounding more like Yes Minister every minute. Now, I can hear you all saying, so exactly how is all this going to affect me? And why is this the case? And what, if anything, can I do about it? Who can give me the honest, objective answers on all of this? Well, over the last few weeks, I've been trying to identify someone who's an expert observer on this really important subject. Someone independent who's intimately knowledgeable across the full spectrum of property, finance and wealth creation policies, as well as the practices and the people involved. Someone who doesn't have a vested interest. And this is where today's guest, Alex Whitlock, is perfectly positioned to give you all the answers. You see, Alex is a director of Momentum Intelligence, which is a multi-award winning media, information and market intelligence business. And they connect over 1 million of Australia's professional services communities across the full range of property, real estate, finance, investment, wealth, retirement, legal, defence and small to medium enterprise sectors. Momentum Intelligence is a leading provider of quantitative research to Australian business leaders. They've got a proven track record of delivering actionable insights to leading financial intermediaries to help shape their strategic direction in very complex markets. Alex's company has received 4 consecutive BRW Fast 100 rankings and is recognised as one of Australia's fastest growing and most progressive media businesses. And Alex also walks the talk in the property arena, as he's an avid homeowner and investor who's accumulated a joint multiple property portfolio currently worth over $7 million. In fact, we start our conversation by getting him to share the intimate details of his journey and learnings in property, so stay tuned for that. Now, I've been a massive fan of Alex's work and his hosting of a number of industry podcasts for a number of years now, including the Smart Property Investment Show with his business partner, Phil Tarrant. I love his passion, his well-informed insights, and his forthright, down-to-earth, tell-it-like-it-is approach. So there's no one better to demystify the Banking Royal Commission so that you know exactly how it's going to affect you. And I can't emphasise enough that we all have a very small window of opportunity to protect ourselves with this. And we need to do this by pestering and influencing politicians of all persuasions in the next few weeks, before the federal election. And the quickest and the easiest way to make a difference is to do just 2 quick things. Firstly, join the recently formed Property Investment Council of Australia by jumping on www.pica.acn.au/membership and paying just $5 a year to join and build the ranks of other everyday Aussie property owners so that we have a unified apolitical voice to educate and advocate with all governments and protect the interests of all like-minded, hard-working Australians. And you don't have to be a property investor to be part of that. So jump on board. Secondly, jump on 2 separate websites to sign the petitions and use the really easy tick boxes to email your local politicians. So you just need to go to www.keepcompetitionalive.com.au. That's all one word. That's keepcompetitionalive.com.au, as well as www.brokerbehindyu.com.au. That's brokerbehindyu.com.au. Now, please get your family, your friends, and your work colleagues to do this now. Now, we cover a lot of really important ground in this very interesting and in-depth conversation today. So stick with us right till the end. Otherwise, you'll miss out on some real opportunities to protect yourself and your future in what is proving to be very interesting times in both the short to medium term. So do yourself a big favour and enjoy Alex Whitlock. Hi, freedom fighters. Now, we've been hearing a lot in the press lately over some changes in the winds, and with all the palaver around the Banking Royal Commission, we've got a federal government election coming up in a couple of months. There's potential changes being talked about to capital gains and negative gearing. And I really wanted to boil it down today and talk to someone that can look at what it actually means to you as everyday Aussies. And I wanted to talk to someone who's independent of the industry, get fully informed and can actually speak with authority as, one, a property owner and investor in their own right, but someone who understands the intricacies of the full spectrum of both the property and finance industries. And I'm very humbled to be able to welcome Alex Whitlock, who's a director of Momentum Intelligence, to Get Invested to talk about that. Welcome aboard, Alex.
Well, thanks, Bushy. That's a very kind introduction. It's a great pleasure to be on, and very, very happy and keen to speak to fellow investors. Fantastic,
mate. Now, I've heard you in person and an avid listener of your work on the podcast that you work on with the advisor, etc.
Yes.
But rather than me try and fumble through who you are and what you do, tell the listeners a bit about yourself, what you do, and run through your history if you don't mind too, please, mate.
Okay. Yeah, look, I'm not a native of this land, English by birth. Left the UK, left in 1996. I'm 51 years old now. Went to Hong Kong in 96, and sort of a couple of years later, I got a job in media. I worked on the sales side, and I had an opportunity to really take my first steps into property investment, which for me was a life-changing experience and something that has been sort of very defining for me. So, I purchased a property off the plan, first purchase I'd ever made. Went through the sort of process of, sort of saved up for a deposit, and then, there is a sort of a delayed settlement of the property's completed. But anyway, the interesting experience for me in the run-up to settlement was that I, to my absolute horror, found that I was unable to find a bank that was actually willing to lend me the money to complete. And, I had a 20% deposit. I had good income and sort of good rising income, but I was really struggled to get a loan. And the developer actually said to me, when it was getting really close to settlement, you ought to look at using a mortgage broker. And I had no idea what he was talking about. First, this was my first purchase. Second, because back in the sort of the late 90s, mortgage broking wasn't very prevalent. And a mortgage broker came over from Australia, actually based over in Perth, sat down with me, and first thing that she said is, "Don't worry, I'll be able to get you a loan," which I just found almost impossible to believe, given my experiences going direct to banks in Hong Kong. So that was my first step into property purchase, financing a property, understanding how horrible it is from a first-time buyer's perspective, and really this absolute lifeline that came from a mortgage broker. So moving forward from there, that really sort of defined. It created a large interest in me in terms of investment. So wanting to better understand investment. So working in media as I did, I started to look at creating publication. I launched a publication called Portfolio, which looked at a range of different investments, but really with a sort of focal point around property. I then got a wonderful opportunity to come to Australia, which I've always wanted to live here. Got a chance to come here in 2001. And again, working in media, I was actually launching a retail property investment publication. And I was calling around a couple of lenders, a couple of non-bank lenders at the time, And one of them said, "Oh, look, before you launch a property magazine, because there was a very strong publication back then called Australian Property Investor, which I used to read, this chap said, oh, you should look at having an industry publication for mortgage brokers." And I went, well, hey, mortgage brokers, well, I know about mortgage brokers. Oh, you know, if there's nothing for mortgage brokers, I'm all over it. So I made a few phone calls. I spoke to some of the aggregation businesses, which were, well, you know, sort of quite embryonic at the time, Plan Australia, some of the more established ones, AFG, and so forth.
Yep.
And then spoke to a few of the lenders, some of the non-bank lenders, small lenders which you may or may not be aware of, Liberty Financial, Pepper Home Loans, and quite quickly realised that there was this growing marketplace of these, you know, these people who'd helped me out of my situation. So I launched a mortgage broking publication, which I ran. It's called Mortgage Professional Australia, and then I launched another one called Australian Broker, which is for a company called Key Media. I left there in 2006 and sort of set out on my own with my business partner Phil Tarrant, and we went into corporate communications because we'd built up quite a lot of knowledge around mortgage lending, particularly around some of the complexities around funding for securitization and so forth. I've got a real, I don't know, maybe being English, I'm sort of a bit of an underdog fan. You know, I was very fascinated by the non-banks because they very much dwarfed by the major institutions. I really loved the fact that in the 90s you'd got Wizard came to the marketplace and also Aussie Home Loans that really looked at the obscene margins that the big lenders had, the banks, you know, the big four banks.
Yes.
Went in there and said, well, we can give 2% of this back to the borrower and we can keep 2% ourselves and we're all making money. And so I was very interested in the non-banks and what they really mean for Australian borrowers. And then, look, subsequent to that, I went back into media, launched a number of publications, another mortgage broking publication, but also went into other areas, a major legal publication, publications for financial planning. We've got Australia's only accountancy publication. We've also got, we're in defence. We're in a whole range of areas. And then I also got a chance to launch, finally, my property publication called Smart Property Investment. And then more recently, sort of a couple of years ago, launched a publication that's also very close to my heart, being the ag I am, which is called Nest Egg, which is really looking in layman's terms at building sustainable wealth, not sort of short-term gains, but really about, you know, helping Australians think about where they want to go in terms of why they're building wealth, how much they need, what their goals are, and then over the top of that, I've always been I've been a bit of a nerd all my life. Very research orientated. In all the publications, we do major research projects. So we actually took the research component out of all the individual publications and verticals, and a year or so ago launched a business called Momentum Intelligence, which I head up with some very talented people, where we now dive deep into certain areas. One of the key things is mortgages, and recently launched a major report looking really at the impact of mortgage broking on the consumer, on the borrower. So trying to get some facts that, you know, really not been looked at so far. Yeah,
brilliant, mate. Brilliant. You've covered an awful lot of territory there, and it's the reason I've got you on the podcast. You
better gather I do a lot of talking as well. So.
And I love that, mate. And that's exactly why you're here, because what I love about your approach is that you're quite holistic and you're quite long-term in your thinking. And
yes.
Each thing you touched on there is a very important part of that nest egg process, which you very well mentioned, which is something that's near and dear to us on Get Invested. We're all about helping people to sustain and maintain their lifestyle by building wealth outside of their employment income. And property is certainly an important part of that. And what I also love about it is that because you've therefore touching each and every element of that process through your business activities, it also aligns with what you're doing personally. And you mentioned that first property that you secured in Singapore. Tell us a little bit, just to dive in a little bit more detail so that the listeners understand the difference between the contact you had directly with the banks versus a broker from Perth telling you in 3 minutes that, yes, you can do this deal. And they probably put it back with one of the banks you'd already spoken to, I'm guessing.
Yeah. So you're absolutely, you know what, you're absolutely spot on. I'd love to share that story with you. So I purchased one of my clients. It's so funny thinking about it. One of my clients in a publication I was running was a developer called Central Equity, which develops and builds properties primarily in the South Bank in Melbourne.
Yep.
And I used to sell them advertising, and these guys were very shrewd and very savvy. They're also really nice guys. And so that rather than me being able to secure a long-term deal, they used to make me come down to their office every single month, and they would sign a month at a time. And they also used to submit an article in conjunction with their advert, and the article would be an informative thing. So it would be, kind of the power of leveraging, or it would be looking at negative gearing, or it would be, understanding, cash flow. So I'd have to read this article. So I'd go along and I'd sort of say, oh, fascinating article on negative gearing. I didn't realise X, Y, Z. By the way, do you want to buy another advert and write another article? And in the middle of their room, they had one of those models with little plastic trees and small people walking around, and so it was there every time I did it. And I remember it was probably after about the 8th or 9th advert that I'd sold them, and the 8th or 9th article I'd read about property investment, that I started focusing on this model. And I said, and of course, as soon as I said, so how much would one of these apartments cost? And I was, my cards were marked. But I purchased a property. I know that they say that people say that investment is not an emotional thing, but it really is in terms of property, because it's not like, I don't know, I buy shares. I'm not emotional about shares. Shares are, they're just purely numbers, with, of ASX listed or globally listed businesses. But property doesn't matter whether you're buying for investment. You're buying bricks and mortar, warmth, shelter that people are going to live in, and it's a creation of accommodation. It's stimulation to the economy because you're stimulating the building industry, and it is emotional. I felt myself looking at this particular, and I literally hadn't thought about it, but as soon as I felt myself going down this pathway of looking at this model, thinking about could I afford to put the deposit down? How long would it be before the property was completed? So on and so forth. It was quite an emotional journey, and I have to say it was a rewarding journey. I came to settlement. So in my role in Hong Kong at the time, I dealt with all the major banks, and there's also a bank called Advance Bank at the time there, which is now St George.
Yep.
So I knew these people very well. They did various things with me in various different areas. So of course I thought, because I knew National Australia Bank, I thought, well, I'll get a loan there because I'll go and speak to people I know. And one by one, NAB, Westpac, ANZ, Advance Bank, I didn't speak Commonwealth, they all turned me down. And you're absolutely right. When the broker came over from Perth, they actually placed my first loan with ANZ.
Yeah.
It was a really kind of tough experience to go from the excitement and also the nervousness, the apprehension of investing in property for the first time.
Of course.
To then getting down to finance and this sort of sense of finance slipping away, and then the reality of what the consequences would be if I couldn't settle was really pretty terrifying for me.
As it is for everyone, and I think that emotional exercise is the reason why property is such a good asset, because people do buy with emotion, and it tends to influence. So for investors to slipstream on that, it's a great vehicle to do so. But the emotional rollercoaster ride you go on in that whole purchase process, and how fundamental that financing it is, if you're needing a bank at all, it can turn an easy process into a very frightful one. And a frenetic one pretty quickly. And tell me, because this is really interesting for me, obviously, because we see this all the time, because brokers, as we see it, are there to get a yes, whereas 9 times out of 10 a bank's looking for a reason to say no.
Yeah.
Is that pretty much the experience you had? Is it just the broker knowing how to present the information in a way that was going to get a yes, versus someone who just looking and saying, well, no, that doesn't fit?
Yeah, it was. And I think, look, I probably... I was, I think I'm probably like quite a lot of people. I didn't understand the process. So, back then, applying for a loan, you need to be organised. You need to have your income and breakdown of your income sort of documented very, very clearly. And I was a bit blasé, and I kind of went along and sort of was a bit vague. So I think the banks got inadequate information from me and went, well, this guy is not somebody we can lend money to. He's a liability. But what sort of, Bushy, what I found, just speaking as a borrower, as an investor, as a punter, what was hard for me was the wall of silence, and then 6-8 working days later, sometimes 10 working days later, just getting a no. And that was the really tough thing. And this happened, 4 different times with 4 different institutions. And by the time I got to the 4th no, and I can't remember which order they went in, incidentally, I was starting to feel pretty crushed. When I sat down with the broker, basically, what I realised firsthand was the broker helped me with the application form. Now, that very simply means made sure that I filled it in properly. I earn really good money in Hong Kong. Tax is really generous over there. You get charged about, 11-12% it was at the time. So, and I earned really good money. So I had plenty of money. I had the funds to complete. Yep. It was really about how I was presented as an applicant, not about any kind of creativity in the work in terms of the way my finances were presented. Just getting things done accurately and in a timely manner. The other thing as well is, that broker, because they were active, involved with dealing with the banks on an hourly basis, working with a lot of clients, that particular asset class. So again, South Bank in Melbourne, inner city, quite dense in terms of the apartment sort of construction there. And what I didn't know as an investor is that because I just thought you go along and you earn plenty of money and you got a deposit, so the bank's going to lend you money. Yeah, it seems to be straightforward. Yeah. What I didn't know as an investor is that different banks have different appetite for different kinds of asset classes when it comes to property. I thought property was just property. So, the broker knew which lender was their policy would be in line with that particular asset class. And I got the decision really quickly from a bank that turned me down in Hong Kong. So.
Yeah, the interesting thing there is that the adding to what you're just saying, it's not only an appetite for an asset class, it's an appetite for an asset class at a certain period of time. Because Absolutely. A lot of the banks will have budget allowances around how much they'll lend in that particular sphere. When they've hit their threshold, they turn off the tap. And the average punter who thinks, a loan is a loan is a loan, doesn't appreciate the nuances that sit in behind all of that, and that policy and asset appetite does fluctuate continuously over time. So,
I'll reinforce that, and I will stuff up the order you want to do things. So I'll fast forward to the last purchase that I made, which was 6 months ago, and I invested in Deception Bay. I bought 2 blocks side by side, quite small blocks, 400 square metre blocks. It's, if you don't know that particular area, it is going through a certain amount of gentrification. It's an up and coming area, but it's still at the moment going through quite sort of a transition in terms of the kind of demographic there.
Yes.
And I went via a broker. ANZ had been very much in the marketplace for that particular, just to reinforce what you're saying about things change. So we went to ANZ to start with, and during the process, they moved out of that particular area. So we changed our application and went to a non-bank lender called Pepper that was moving into that particular area, had an appetite to lend there. So You're absolutely correct. It isn't just a matter of we don't lend in this one area. You move around. Once a lender has fulfilled its criteria, its appetite for a certain postcode, asset class, whatever, then they cool off on that, and then they might go back in a bit later on. So you're absolutely right.
Yeah, and you've made a really good point in that loans aren't vanilla. And it's the complexity that's now attached to the whole lending sphere with the number of products, the continual dynamics in relation to policy change, almost on a daily basis now, Alex.
Yeah.
Means that the average person who traditionally has bought the property and then gone to their bank and gone, right, get me a loan, they're in for some very challenging times because the world has changed very significantly, particularly in the last 12 months. And I guess that the underlying theme there is that if you're just dealing with a bank teller who might be doing a personal loan now and a credit card the next minute, and 3 months' time he'll be off in another branch somewhere, then knowledge of the lending policy is pretty limited. And it's the reason why it took you so long to get a no, because it's not until it hits the credit desk of the bank that they go, no, reject. And so you've got a long, slow, painful no versus someone who's dealing with this every day and minute of their working experience where they can look at something just as that initial broker did in 3 minutes, say, well, yeah, there's a deal here. We'll get this to work for you. No, that's awesome, mate. Awesome.
I think just look, I've taken loans directly from banks, but not for a long, long time. And when I first moved to Australia, my broker was in Perth. For my next purchase, I actually went back to ANZ because I was very, very pleased with ANZ as a lender. And I walked into my local branch in St Leonard's, which is where I worked. And the branch manager there was absolutely fantastic. She was really, really on the ball. And I got an ANZ loan through her at branch level. Yep. But you know what? It's kind of the luck of the draw. But at that stage, I thought, well, okay, that's good. And then I went back to another branch to try and get another loan. And I had a completely different experience. And that was the last time I ever walked into a branch to get a loan. And because it is luck of the draw going into a branch. Because if you've got, and again, it's luck of draw, because if that lender is lending for your particular need at that particular time, that's one thing that's lucky. The second thing is having somebody that's on the ball, and that is so important, to have somebody who actually is on the ball and gets things going and hustles. The third thing is having somebody who actually understands mortgages. And occasionally in branches, you'll get really talented people who understand a whole range of their own branch products, mortgages being one of them. But my experience often, and I'm not anti-bank per se, but in terms of mortgages, I believe in going to the source that's going to get the best outcome for me as a borrower. And the problem with going to a bank branch of any brand is you may well end up with somebody whose first role is not to deal with mortgages, but what they do is they will run through this sort of like pre-scripted. Really, for me, as somebody who's taken out a lot of loans over the years, I can just tell it immediately. And there's one lender, Westpac, where we took out a Westpac loan through a broker, and Westpac, I don't know what their policy is now, but at that time, they sent you off down to the bank branch. Myself and my business partner, we've got a joint portfolio, which we maybe touch on a little bit later.
Sure.
And we were sent down to the local Westpac bank branch, and the experience was just crushing. And we were sat there with somebody who knew so much less about property than we did, but still went through this really rather painful kind of process. So it's the problem is it's the luck of the draw. I've had some fantastic experience with a really good professional at ANZ. I've had some really dreadful experiences with, I'm sure, very good people. They just don't understand mortgages, even their own mortgages.
I agree, and it's almost the McDonald's formula that do you want fries with that? So here's a credit card, and we'll flog you the insurance and all the palaver that you don't need and don't want. And yet they don't understand the fundamentals of how you need to structure things, particularly for a sophisticated property investor like yourself. And then they're only offering you what they can offer you, not the 39 other lenders and 2,000 loan products that are out there that might be better.
One thing I'd like to, look, I am an experienced property investor. I'm not, there's things that I don't know everything. But I'd say to you, even for the first-time investor, in many ways it's more of a liability for a first-time investor going to a bank, because, you may get advised by somebody who works in the bank that a particular type of structuring, i.e. principal and interest, or fixing interest, or having an offset account. So you end up with people, particularly for investors, you can end up getting some very poor advice from people who work in banks because they don't deal with mortgages and different people with different levels of experience enough. They'll just do what is on the sort of the song sheet they've been given. So a broker, from my experience, and I've dealt with lots of different brokers, will look at my need first and foremost, and they understand when an interest-only loan is going to suit me best, or when a principal and interest loan is going to suit me best. I've never been with a broker that's ever recommended that I fix my interest, but I've regularly consulted my broker to find out, not necessarily should I fix or not, because that's my decision as a borrower, but just to get a bit of a sense of what kind of deals there are in terms of fixed rates. So I think, even as a first-time buyer or investor, you can probably come more unstuck going to somebody who doesn't really understand investment, because they'll just recommend things that they think is okay, but they don't know for a fact. Whereas most brokers that I've dealt with, because they deal with investors, some that have got one property, some that have got 30 in some instances, they understand how to structure investment loans.
Absolutely, and the devil's in the detail too. That's unfortunately, the banks like to dumb it down, so the only thing that people focus on is rate. And even on that basis, rate is no indication of cost, because when you factor in ongoing, outgoing, offset account potential impacts on cost. A good broker will actually, apples for apples, look at what the true cost of a loan solution is rather than the rate. And then all of the other risk protection that gets brought in versus, if I'm working for a bank, the only risk I'm trying to protect is my bank. I don't really give a hang about what's happening to you. I just want to make sure that I'm protected. So, no, that's really interesting, mate. Well, tell us a bit more about your portfolio, because that'll be interesting. So you got the one in Melbourne as the first one, and the last one.
Well, I had the one in Melbourne.
I'm
the classic investor who doesn't have the first investments that they bought. I actually bought off that developer. I bought 4 apartments, and I sold 4 apartments. You know what? I made an interesting. I made good money on all but one, and again, you know, I moved. I was really, really keen once I got going, and I bought and moved to Australia because of the very favourable tax in Hong Kong, and because there was a lot more money. You know, the job that I did paid more money there. When I came here, I really all my life wanted to come here, so took a bit of a haircut and took my salary. Had to make a sale of one of my apartments. It's the only property I've ever lost money on. I lost about $10,000 on that apartment. So the first one I bought in South Bank, I bought it in 1998. I think I settled in late 99 or something like that. And that was $217,000 for a 2-bedder in a fancy apartment block.
Yep.
And I sold that about sort of 4 or 5 years later for about $120,000 profit. But one of the interesting things, so that one thing that you learn as you go down the path is you've got capital growth in terms of your property, and those apartments in the South Bank all have really good capital growth.
Yep.
But one thing that I learned was really about the cash flow.
Yes.
So one of the things that, and everyone's got their and everyone's got their own preference in terms of what they like to invest in. So I'm not an advocate for one particular asset class or another. But one thing that I learned was the price of holding property with swimming pools and tennis courts and big public areas. That's an expensive asset. There's a lot comes off in terms of the body corp and so forth. So you end up, it's one of the reasons why I'm doing what I'm doing now, and one of the reasons why I'm so passionate about property, and I'll get onto the SPI portfolio in a moment, is to show investors, fellow investors, warts and all, the realities of buying property. Because if you read some of the investment publications, they're very, very inspiring. You hear about investors that go from X to Y and millions of dollars, but the reality is that it's not really quite the case. That after all the deductions, you look at all the true costs of investing and all the true costs of holding. You can do really well in property investment, but you've got to really have your eyes open to what those costs are. So first 4 properties were off the plan. All in South Bank, all from Central Equity, and all went up in value, save the one that I had to sell because I had to sell it at a time that wasn't very suitable. So that was not the fault of the developer. Had a bit of Bushy had a bit of a hiatus after that. So I got young kids. My kids were both born in Hong Kong, but they were sort of getting a bit older, and there was pressure on me to slow down with my aggressive investing and to have a bit of focus on looking after the family and actually take us out of rented accommodation. So I reluctantly had to liquidate some of my portfolio and go and buy a home, which, at the end of the day, was actually a really good move. And, it's been an important thing.
Absolutely.
So, and then, as I sort of touched on earlier, when it took the leap into setting up a business with my longtime friend and business partner, Phil Tarrant, and we stepped into that in 2006. So again, there was my own personal goal to build up a portfolio. Really was I got a couple of properties left in that portfolio at that stage, but wasn't in a position to look at leveraging any further. Property market had been fairly flat. I know that there is no such thing as the property market because it's a patchwork across Australia, but in general, markets have been fairly static. So we moved back into when Phil and I we set up SPI, which is Smart Property Investment, because we wanted to do what we love and what we care about, and looking at the enabler through property investment. And I love property for a host of reasons, but the fundamental reason why I like property is it just ticks my boxes on a personal level. One, I'm really not that smart, and you don't need to be a rocket scientist to invest in property. You just need to have a bit of discipline.
Yeah.
The second thing is I'm really, really impulsive, and you know, I dabble a little bit in shares, and I make the worst possible decisions for the worst possible reasons. I panic and sell because I think that everything in the world's, you know, going to fall apart, or I buy because I think, you know, everything's going to explode into rainbows. The great thing for me, the way that I'm wired with property, is it is just, you can't do things quickly in property. So, you know, it is very, very important to me. So, you know, launching smart property investment was really critical to me, something I believe so fundamentally in. And I want to share with other Australians and anyone else that has an interest, so the realities, the simple realities of making informed decisions around property investment. So what we wanted to do, Bushy, when we launched SPI, rather than just marketing, those that are in the profession, marketing their services or their products or whatever it is that they do, whether it's buyers, agents or developers, we decided that we would start investing in a portfolio, and we would show how our investments went, warts and all. So we bought, we published the purchase price. We went through every facet of all the expenses, documented everything, every single penny that went on expenses. We detail every single penny that goes out on a regular basis. It's available on. It's called Property in Action. It's on the SPI Smart Property Investment website. If anyone wants to take a look. So we built that portfolio. We started building that in 2011, and we started off in New South Wales. So back then in New South Wales, particularly in and around sort of Western Sydney, you've got this really sort of pent up. You've got a sort of a supply of property in certain areas where the prices were really, really low. So I hadn't typically looked. My business partner Phil is. He originates from Seven Hills, which is sort of out west in Sydney, so he knows that area quite well. And we looked at the prices out there, and just for the Sydney market, you were getting properties out west that were really cheap in comparison to sort of stuff that's located similar stock, either sort of upper North Shore, sort of down in the south, getting in towards the inner west. You go out a little bit further out west, sort of beyond Parramatta, and there's some. In St Mary's, Mount Druitt, there were properties which were just unbelievably affordable with really good yields on them as well. And
yes.
I've come to sort of see over the years that there is this balance, not always, but often a balance with the price or the value of a property versus the yield. And if you look at many markets at the moment, because you've had, sort of exponential growth, particularly in Sydney, the yields are very, very low. And that's really a symptom of huge acceleration in terms of property values without the rental yield having a chance to catch up. When we're looking out west and seeing rental yields of 7, 8, 9%, that said to me, just simply said, this is a market which is probably gearing up for some sort of growth, some sort of capital growth. And anyone could look at the prices, seeing 3-bedroom houses going for like $215,000, not that far outside Sydney. It's not hard to work out that potentially you're going to get that groundswell in value. So, we started investing out west, and look, just I won't go through every property in detail, but the total purchase price across that portfolio, we've got 17 properties in that portfolio. The total purchase price at point of purchase was a total of $4,314,000. The estimated value of that today is $7,405,000.
Nice.
We've had the growth since we purchased that has been a sort of circa about 70% growth. We've got debt on that. We've got a lot of debt, and we've got debt of $5 million. Which, if you'd have told me that 25 years ago that I'd be $5 million in debt, I would have laid down and not been resuscitated. So it shows.
Alex, my father always used to say, "It's the bank's money; let them worry about it." And I thought that was great advice, mate. It's not how much you owe; it's how well it's working for you, really. And
but you know what, Bushy? We've had a really, really, really solid partner. Our mortgage broker has been pivotal in helping us grow our wealth. And I'll just give you the background to that. So when I first came to Australia, and obviously through negative gearing and managing my tax, I had an accountant who was actually out west. So he was really, really, really hard-working guy called Brian McEwen. Charged me next to nothing, and really had such a huge value on me in terms of advice around how to structure my investments, and just a really genuinely nice guy. So through Brian recommended a mortgage broker called Ross McCain, who's a mortgage broker for Aussie. So we sort of met up with Ross, myself and Phil, started using Ross. And of course, in a relationship, it's a bit transactional the first time because you don't know people, and you start to, the first thing is that we need to get a loan, and you go through the process, and the loan is secured, and you sort of get a sense for the fact it's worked well. And then we use the broker again. And then the bonds of trust start to evolve. So Ross then introduced us. So through Ross, who'd been introduced by my accountant, Ross then introduced a buyer's agent that they had a relationship with. But because now Ross knew his stuff inside out. He was thorough to the absolute, tiniest detail with everything around our investment. He understood investment absolutely in every single intimate detail. So when he recommended the buyer's agent, there was a high level of trust in that recommendation. And the buyer's agent is a group called Right Property Group, and they have helped us grow this portfolio. So again, I come back to what I said. I'm not a genius. I'm not a rocket scientist, but I've got the great thing about property investment is you have people around you, a mortgage broker, an accountant, somewhere along the lines of a lender, because let's remember, the lender will look at your investment and they'll go, am I going to lend or not? And as long as you get a lender that lends on that particular asset class, they will help you decide if they say we're not going to lend, you know what, it may or may not, it may not be as good an investment. So you get all this help as an investor from all these different points to help shape the way that you go ahead. It's not infallible. You're not guaranteed to make money. You've still got to, put the right moves in yourself. But we're very, very. It is a partnership for myself and Phil. It's a partnership with with our mortgage broker, with our accountant, with our financial planner, with our conveyancer, with our insurance broker. So we have a team around us. And you know what? Our mortgage broker charges us nothing, which is unbelievable. And I go back to that first time when I got this loan back in Hong Kong. And I sat there quaking when she came in, and she said, blah 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 blah, $1,500 commission, and I went, okay, so do I pay this now or do I pay? She went, no, ANZ will pay me that. And I sat there, and I could not believe the fact that this woman had saved my life, but I didn't have to pay for it anyway. So as an investor, I get huge help from. We pay our buyer's agent. We pay our accountant a small amount of money just to help with tax. We pay our mortgage broker nothing, and then you pay standard fees to conveyancers and insurance brokers. So we get a lot of help in terms of building our portfolio.
Yeah, it's a brilliant recognition though, Alex. It's I always say to people, property's an elite team sport, but you're not a player. You just manage the managers. That's your role. You get on with what you're good at, which is what you're doing with momentum. And providing you've got a good team around you that are elite in each position but understand each other, and more importantly, understand your strategy and then execute it, then you've got a very good way safely and affordably and enjoyably to actually build wealth while you continue to focus on your career, your income, and your friends and your family.
Totally, Bushy. And then, of course, the other part of the team that I haven't mentioned is, post purchase is then the property manager. So we use property manager. We don't manage any of our properties ourselves. And you find the right property manager as a partner, and they're invaluable to managing that asset, making sure that they get the right kind of tenants, helping advise on market rentals, because let's face it, you don't always know. I've got a place, I've got a place out in Tassie. I've got places up in Queensland. I don't know what the rental market is there. So the property manager, advises on rental growth, on what we should be charging, keeping things, retaining good tenants. So you have a team around you to help support you with your investment portfolio.
Yeah, and spot on. The property manager is the person who holds your most expensive asset for the longest, so you need a damn good one. We're hot on that.
Absolutely.
that aspect of it. And for the listeners, I just want to reinforce my support for the fantastic work that you and Phil do with SPI, or Smart Property Investment. I'm an avid fan and have been for many years, mate. And
thank you.
I just love the open book approach that you have through Property in Action. It's real numbers on real properties, so that there's no ducks and drakes, no smoke and mirrors. You can see it there, warts and all. So
I think you have to take responsibility for your. I believe very strongly in taking responsibility for yourself. In life, in finance, I think understanding what your goals are. Now, I don't believe in greed per se, because if you know what you want and it's realistic and it's achievable and it's measurable, then that's okay. I think greed is when you don't have a realistic view of what you're setting out to achieve, and I think unfortunately, greed comes often with ignorance, and I think people fall foul of making bad investment decisions when they haven't really thought through what their goals and objectives are. So with SPI, with Investment in Action, we just want to really show people that you can build wealth slowly through property investment. It is not. I think the dangers of falling into the traps of the less scrupulous operators out there are people who don't look at the whole setup and maybe are drawn into making money quickly. Now, we've had some properties that have just, flown in value, but that's been really sort of accidental rather than setting out with any strategy of properties like doubling in value. We've got some properties that doubled in value in as little as 5 or 6 years, but that's not been because we've set out to try and cherry pick properties that are going to rocket up into the stratosphere. We've bought properties that we feel we're buying under market value, that have a good yield, that have good potential for growth, and are in a sustainable area with good infrastructure. And it's really about being conservative first and foremost, with modest growth, rather than ending up with a lemon that you end up in trouble. So, but look, you know what? By default, if you buy wisely, if you get good advice and support from people around you, if you do your own due diligence as well, not blindly listen to what you're told. Use your own common sense as well. Like I say, I looked at those properties out west and went, look, this kind of in a city environment rather than say remote or regional, when you've got a high yield, and you look at comparable markets, close proximity to the CBD, common sense says to me that those are markets that are going to go, and I get that reinforced by my buyer's agent, and I get that reinforced by my mortgage broker, and I get it reinforced by my lender and everyone else in that particular team around me.
Yeah, it's really good advice, mate. And taking that long-term approach, getting the team around you, being very clear on what your goals are and how property is going to contribute, that are fundamental if you're going to last a distance. And you're sort of echoing very, very much the approach that myself and my good wife have taken, but on a different scale. Because at Adelaide, of course, median price here is well under half of what it is in Sydney. But we early days, we adopted a very similar approach to you. We bought properties. I can remember I bought one down south of Adelaide for 84,000. That's now worth about 440.
Wow.
And that's a 3-bedroom home on a half-acre block. So very different scale, but very similar approach in terms of looking at areas that aren't there yet, but have high potential, really good rental yields. But there's a lot of demand and infrastructure that's going to start pushing up the capital value. So, no, awesome, mate. Look, that's been a really good rundown, and now all of us have got a really clear picture on what you do and how much you get your hands dirty in the property investment space. So it's always good to talk to someone who does what they tell other people to do, because that's a bit of a rarity on occasions in our industry, as you'd know better than I. But, mate, what I'm very keen to pivot now to is the winds of change that are upon us. And we've already seen, as I've mentioned already, property is a game of finance. If you can't get your hands on the money, you can't get your hands on the property. That's as simple as it gets. And there's no doubt about it. There's been a lot of focus on the banking and finance industry, particularly over the last year and a half. There's been half a dozen different and separate studies done on the whole system. Brought to a head, of course, by the Royal Commission on Banking and the misconduct focus there. It's probably, we're in a bit of a window, I think, where we've got a federal election looming, and Therefore, things get much more political than what they would otherwise. But it also means that people quite often start making massive decisions on very little information. And part of the reason for getting you on today is to really drill into the Royal Commission on Banking. I guess demystify it for the listeners in terms of why did we have it? What were the outcomes? What are the potential implications to the average person on the street if they're endorsed? And then politically, what are each side thinking, and how should that start influencing individuals in terms of where they're going to put potentially a very important vote over the next couple of months?
Yeah.
Right? So breaking it down, the Royal Commission on Banking, talk us through, because you've had your hands all over this in terms of keeping an eye on what it's doing. Just in very simple language, can you just talk through what it is, why it was called, and then what the recommendations were, and then we'll start looking at impacts from there.
Yeah, no, sure. I mean, the Royal Commission's been, Labour has called for a Royal Commission many, many times. Coalition has resisted for one reason or another. It's fundamentally, look, you've got some very, very powerful financial institutions here in Australia, but look worldwide, and it's no secret to all of us that, you know, they're there to make money and they're there to make money out of their customers. The issue is, you know, where is the customer placed in terms of the focus of the institution, and are they putting their interest before those of the customer they're supposed to serve? So this was an investigation into misconduct across financial services. It was broken down to many, many areas. The area, you know, superannuation being one of them, banking, financial services. The area that was of relevance to myself was really around sort of the mortgage function from the bank. So as the banks were dragged in front of the Royal Commission one by one, one of the areas that the Royal Commission wanted to look at, and quite rightly so, is the issue of conflicted remuneration. Now, why is this an important issue? Well, let's just move away from mortgage broking for a second, and let's look at another area of financial services, which is the investment side of things, so financial planning. So you need to look at who is paying the financial planner, where their incentives lie. Because if me, as a hard-working Australian, maybe retired, maybe running up to retirement, if I've got $50,000, $100,000, $500,000 of my own money, and I'm being advised as to where to put that, you've got to look very closely at what the incentives are for directing that. Am I being directed to where I'm going to get the best return on my $500,000, or is it where the person who's doing the advising is going to get the highest commission? And that in financial planning is critical, because, Bushy, at the end of the day, if you get bad advice around financial planning, you know, the outcomes can be catastrophic, and you can end up with no money or a severely impacted investment, you know. Yeah. So that is a big issue in terms of, so conflicted remuneration, in essence, is something that the Royal Commission was very, very keen to look at. Okay. Now, in broad brushstrokes, it's very easy to go, okay, well, let's have a look at everybody. Let's have a look at how everybody is paid. Who does the paying? Okay, let's look at mortgage broking. Okay, who does the paying there? Right, I see. So the banks are, as I mentioned to you earlier, when I was told by my broker that the bank was paying them, I was overjoyed, and the service is free to me. But quite rightly, the Royal Commission is saying, okay, look, let's investigate what the ramifications are around a lender paying a broker to bring a borrower, you know, in theory, to that particular port of call. But the reality is, what you have to. The Royal Commission looked into remuneration. Now, where things get very complicated, Bushy, is that the banks. So you've got in Australia. I don't know. You've got 4 banks that have a very significant footprint in terms of retail here. They dominate the marketplace. They have around about 80% of the market share at the moment, which is starting to show signs of erosion since mortgage brokers have opened up the marketplace, first of all to more Australian borrowers, but also more importantly to more Australian lenders. But I'll sort of touch on that a little bit later.
Great.
So what you've got is, you've got, you need to look very closely at, sort of who these lenders are and what their motives are, and what the impact is for borrowers being taken to certain lenders. Now, if you look at the financial planning scenario, the ramifications are quite significant because I'm handing over my money to a financial institution who will invest it well, badly, mediocrely. In mortgage broking, it's very, very different. And so really, to connect, mortgage broking is very, very important because, in essence, you can look at it simplistically and say, well, hang on a second, the lender is paying a commission to the broker, to the borrower, so therefore it's conflicted. The reality is, for me as a borrower, and I'll just speak as a borrower before a researcher, when I need to borrow money, you don't go to 20 banks and they're all going to lend you money. The chances of finding one bank that will lend you money is really quite hard. So what a broker does, you have to understand that the broker doesn't, like, if I've got $100,000 of my money, I can promise you, if I go to a financial planner, anybody will take my $100,000. If I want to borrow $100,000 as an investor, you may only get one bank that will consider lending you that $100,000. The other thing to remember as well, just comparing the two analogies, if I have $100,000 to invest with 20 different fund managers, you will get a myriad of different outcomes depending on where those assets are placed. So I could be investing into, small cap Eastern European tech funds, or it might go into a global kind of balance fund. You get very, very different investment strategies, very, very different returns. When I'm borrowing $100,000, I am borrowing $100,000, a stack of banknotes, which is it's the same wherever I go to, whether I go to ANZ, CBA, Westpac, Pepper, Liberty, La Trobe. It doesn't matter. It's still $100,000. Yep. The other thing is as well, the interest rate is almost identical. You were talking about dollars and cents in terms of interest differential. So back to this issue about remuneration for the Banking Royal Commission, looking at how brokers are paid and who they're paid by was a real critical thing. Now, one of the banks, CBA, had an agenda through the Royal Commission. So CBA had looked very closely at a model overseas, which is based in the Netherlands. CBA had gone away and had a very close look at this model and had seen that in this marketplace where the borrower effectively pays for the service of a broker, what the CBA had seen is that, never mind about the outcomes for the borrowers, the banks in that marketplace had retained significant share because of the restructuring of that particular marketplace. So CBA basically put forward, was an advocate of the Netherlands model, because in principle saying, well, I think it's, a reasonable proposition that the borrower should pay a fee to the broker because then there's no conflict. The motives were ulterior, I believe, that it was probably in the best interest of the lender and not in the best interest, certainly of the borrower, and certainly to the detriment of the broker. So I was watching the findings of the Royal Commission and I was so incensed by, what really annoyed me is you have a very few people talking about Australians as if they just don't matter. Going, yes, we think it's best for Australians to have to pay a fee to a broker. I just thought, hang on a second, 60% of Australian borrowers now choose to use a mortgage broker, and that has grown year on year on year on year on year. And what you're essentially saying, Mr. Hayne, CBA, is that most Australians are idiots. They don't know what's good for them. That even though they're not getting the right outcomes, every year more and more and more and more borrowers go and choose a broker. So I thought, well, because we reach about through the media titles. On the other side of my business, we reach about 1 million Australians every month. So we decided that we would go out and we would survey those 1 million Australians and find out exactly what they thought. So we decided to do. I wanted to do a survey. We reach about 1 million Australians every month through our through our various media assets. So I wanted to find out what Australians thought, what their experiences were, because no one has. There's going to be this legislation potentially going through, which will change the way that Australians access finance, and it would be dictated to them where they go. Essentially, there's a danger they'd be forced back down to the branches they've been departing from over the last few decades. So we went out and asked a question. So we asked borrowers, 6,000, close to 6,000, 5,800 borrowers complete the survey. We found out, we asked them whether they went direct to a proprietary channel, which is primarily a bank, or if they used a broker. So the first thing we want to do is really look at satisfaction from the channel. So first of all, for brokers, the satisfaction levels were of those that were very satisfied and satisfied, you had a total of 96%. So that is
massive,
remarkable. If you break that down a little bit further, so specifically 84% were very satisfied. So that's really a resounding endorsement. Whereas if you look at the, if you look at those, from, in terms of those who used a bank, you had about 67% said that they were satisfied or very satisfied, but only 26% said that they were very satisfied. So you've got a real gap in terms of satisfaction levels. It was quite interesting to look at why, customers went to a channel. They went because they believed that they were going to get the best product for their needs. They believed they're going to get a choice of product, which is bizarre when you walk into a bank branch that you think you're going to get a choice, but there you go.
Yeah.
But what was interesting really was digging down a little bit deeper, is finding out, looking at loyalty to that particular channel. So
yeah,
asking customers whether they would return to the same channel.
Critical.
95.8% of those that had used a broker would choose to use a broker again. And I'm not necessarily saying use the same broker, but would use that channel.
Massive.
So this says that basically that the outcomes that they sought were almost, unanimously delivered by that channel.
That's an unheard of sort of result.
But if you look at the proprietary channel, you only had about 31% of borrowers that would choose to go back to that channel, and this really reinforces data that I've really mapped over the last 2 decades, which has been the growth of the mortgage broking market from about 15% when I first came to Australia in 2001 to now 60% of all new loans are being written by mortgage brokers. Now this is just Australians who are en masse moving away from the banks, branch-based banking, and certainly acquiring a mortgage. There are just better options out there than what may have served Australians 30, 40, 50 years ago. It's just not the primary choice anymore.
Yeah.
So that was really, really important. But the real essence of this report was really to look at what was being proposed to the Royal Commission, which was this issue of conflicted remuneration. And I know as a borrower that I've used a broker. Including I've probably used a broker 50, 60 times over the years, through refinance, through new purchases, through various kind of transactions. So I believe very strongly in them as a borrower.
Yeah.
But I wanted to find out what people's attitude was to paying a commission, because this was the proposal.
Of course.
The proposal was that we moved to this borrower pays fee. So we asked borrowers, we had a little statement at this section of the survey saying, the broker is paid a commission by the lender upon settlement of your loan. So with this in mind, would you be willing to pay a fee in replacement for the broker receiving a commission? What would be your willingness to pay a fee? 58% of those surveyed, bear in mind that this is 96% of them are satisfied or very satisfied, 58% said that they would not pay $1 to a broker as a fee.
Wow.
Now, from my interpretation, this has nothing to do with the value. The value is already clearly stated by channel loyalty,
yeah.
That 96% of people are satisfied or very satisfied. 95.8% would go back to that channel. However, as soon as a fee is put in place, 58% won't pay a fee. Now, my position on that is because mortgage broking has always been free. Yeah. People don't like to pay for something which they believe and understand to be a free service.
It's almost, and unfortunately, Alex, it's almost generational now. It's nearly 30 years that people have had access to it. So if you go from getting all that value for nothing, effectively, to suddenly I might have to pay a few $1,000, well, it's pretty obvious what the answer is going to be.
But you've got to look at it. You've got to look at this from common sense, and this is the really critical thing that brokers do. So for me as a borrower, I can go and have a look online. I can go and look at interest rates, and I can go and say, the XYZ, who I've never heard of usually, is offering, a 3.2%, interest rate. But the reality is when it comes to taking out, a $500,000, $200,000, $1 million debt, I really need to go very, very carefully. So the value that brokers, anyone can look and see what interest rates are. Every bank publishes their interest rates. That's straightforward. But I need a broker to help me, first and foremost, with the application. Secondly, to understand where policy is right now, so I don't waste my time going down, down a blind alley with a lender. So, but the reality is, 58% of borrowers said, okay, look, I will go back and go through the burden of doing all that myself. But, you can say that still, 42% were prepared to pay a fee. But the really frightening thing for borrowers and look for the industry is that only 3.5% of those that were surveyed would pay a fee that is equivalent to just the upfront commission, not the entire commission the brokers rely on. Bear in mind, brokers don't get, what people don't understand, brokers don't get paid a salary. Brokers don't get paid for their work. Brokers only get paid when a loan is successfully settled and the borrower has got the right outcome. And I know there's times where my broker has gone down the path. They put, like I said, with Section Bay, they put an application in with Section Bay and it knocked it back. Well, guess what? The broker gets absolutely
nothing.
Zero that work. So then they resubmitted the application, went back down the path with Pepper Home Loans. That broker only got paid when that loan was settled with Pepper. So you've got to understand
I just want to put some colour around that if I can, Alex, in our own local situation here in Adelaide, because the average loan size here in Adelaide is a lot lower than what it is in the eastern states, obviously, because the property value is a lot less. So, we keep very close records on this, and over the last 12-odd years, the average loan size is about 320 grand.
Okay.
What that means in terms of how the brokers get paid, as you say, they don't get paid often until 4 to 8 weeks after the loan settles, by the way, by the time the money filters through. So there's quite often a 4-month period from the day you come to see me to the day I get paid a cent for doing that work. For that $320,000 loan, the average initial payment, called the upfront, is about $1,750 odd. And then the trail, which diminishes over time because it's set in accordance with the loan amount, and to us, trail is. So, Bushy, let me just to clarify. So, a commission is paid to a broker upon a successful settlement of a loan. Some of that is paid up front, and some of it is deferred over the life of the loan to support the broker in servicing the client. So that's the trail that you're referring to. Yes. So that ongoing payment, as we see it, is to service all of the other needs that a client requires. Now, in the Adelaide context, that ongoing payment equates to less than $10 a week. That's what we're saying. And if someone approaches one of our brokers and they need to do a top up or a product switch, or they go from variable to fixed, or from interest only to principal interest and vice versa, or if they have any issues with their online banking, or that they're just not sure about the bank, so they'll ring us and then we'll have the discussion for them. You don't need to clock up too many hours before you're well behind on that. And I don't know of many people that would take on a job where I see you today. On average, there's about 60 hours work between the brokers and the admin support to produce a result. Now, if you do the maths on that, at $1,750 I get paid in 4 months. I've spent 60 hours doing it. That's about $35 an hour. So it's not a massive amount of money that they're doing for it, which makes me laugh.
This is why I want to get out and do this survey, because at the end of the day, and from me, I'm not a broker. I'm an investor. I'm also somebody who has access to information. But I sort of took a step outside and went, and just bear with me for a second. But in many ways, look, who cares? Within the industry, brokers obviously have to look at their livelihood. But I try to step outside of that and go, okay, look, certain industries get disrupted all the time. Who really cares if mortgage broking disappears? Yes, you'll have 17,000 people out of jobs, and that's terrible. But let's just try and look at this in the cold light of day. It isn't about why is sustainability of broking so critical? It is for Australian borrowers. And let me tell you, if mortgage broking goes because you rip the guts out of broker remuneration, the consequences for us, for people like me, are significant. You will have, first of all, you have got a whole network of lenders that many people don't know about if you're not in the industry. But mortgage broking opens up a level playing field for challenger brands to get in there. Now, why is this important? Well, this is important very simply because they can charge competitive rates because they're small lenders, which mean the big four banks have to keep their rates down. Now, the big four banks want to charge as fat a margin on top of their loans as they can get away with, because at the end of the day, let's be really clear, banks give back first to shareholders, not to borrowers. Yep. Okay?
Yep.
So this whole issue about broker remuneration can get a bit lost in translation, but for me as a borrower, the reason why I looked at this with horror and felt that I wanted to do something to help educate government, media, and really everybody out there is about, let's not get bogged down on broker remuneration. And if you're a broker, it's critical, but what does it mean to Australians? Well, what it means is if the reason why there was a cynical move from certain lenders to try and disrupt or dismantle the broker market by attacking broker remuneration is the outcome will be brokers cannot sustain their business. Smaller lenders don't have a level playing field to compete, so then they start to drop out the market. As competition diminishes, the major banks push up their margins, okay? So that means higher interest rates for us as borrowers. But the other thing as well is what they do is they stop lending to self-employed people. They stop lending to people with irregular income. They stop lending on properties they don't want to lend to because there's no competitive pressure from smaller lenders to force them to lend the money where they don't particularly want to lend. Because you know what? Every bank has a quota. When I've lent my quota and when I've pumped up my interest rates, hey, happy days. I'll just sit back and I'll continue to lend to the people I want to lend to. You know, for Australians to continue to have access to competitively priced finance, mortgage broking is critical. For mortgage broking to remain sustainable, they need to be able to make a living from doing what they're doing. And my survey said very clearly, you know, that people just will not pay a fee. And if you have to switch to a fee-based service, mortgage broking will crumble. This is why I push back very hard and put out research. And look, I'm not a lobbyist, I'm not a political animal, but I provided it to those that have been lobbying. It's you know, the report that we put out has gone to both sides of government, and it's helped educate you know, politicians that are involved in the decision-making process about how critical mortgage broking is to the Australian economy and ultimately to the, you know, to the favourable outcomes of Australian borrowers. And it doesn't matter whether you use a broker or whether you use a bank, because this is the thing, you know, Australians, should have choice. It should not be dictated to say, yeah, you people can't use a broker anymore because we're going to rip the guts out of the way the brokers are paid. Everyone should have a choice. If you want to use a bank branch, and I have done in the past, hey, use a bank branch, but you should be able to choose. And even if, whether you're a broker customer or a bank customer, the tide will rise on every loan, because as soon as brokers, you know, the impact they have on competition goes, everybody's mortgage rates will go up.
Yeah. Yeah, well, we've seen...
Sorry, I'm getting all worked up again.
No, and so you should. And I guess I'm a little bit jaundiced looking from the outside in. Now, you know, we've got a small boutique concierge business here that looks after the needs of our stable of property investors and homeowners. But I don't know whether you're a fan of Yes Minister, Alex, but yes. It's very reminiscent of what I'm seeing there. So what interests me is it was the 4 banks who called the Royal Commission in the finish. So, yeah. And there's a bit of a big flag that goes off my head when the people that are going to be reviewed are the ones who call for it. There's an opportunity there potentially to influence the terms of reference. So there's a focus on misconduct, and misconduct, correct me if I'm wrong, represents less than 1% of all the transactions in the industry. So it's a microism of what we're talking about, and if following the Yes Minister sort of exercise, government goes, great, we can blame someone else for making some really hard recommendations. We can get some great press out of this in a run-up to an election. And we've got to find a scapegoat who can't defend themselves to pin the tail on the donkey.
100%. It's just so easy brokers. As well. It's just so easy to point the finger. It's so tangible to, you know, and if you don't understand, you know, there's so many journalists that I believe that my report and many people in the industry have been able to educate mainstream media journalists, and the penny has started to drop. I'm seeing far more balanced reports in the Fin, the Australian, you know, in various of the mainstream media, because in simple terms, looking at that remuneration, saying, oh, hang on a second, you know, a commission-based payment from a lender, is really easy to draw that conclusion that it is a conflicted incentive. The thing is, just thinking about something you were saying earlier in terms of one thing you've got to remember, for a mortgage broker, yeah, you're right, you may have to wait, you know, 10, 12 weeks, before you get paid. But I can tell you, for myself, for my mortgage broker would always say, Alex, get a pre-approval. Well, guess what? He does that for nothing.
Yeah.
He will prepare a pre-approval for me, and then, you know what? I haven't even found a property yet. I'm going to start looking. I may never use that pre-approval that he has created. He's given me a pre-approval, and then I find a property. The chances are then that the pre-approval is for a certain amount. I then have to go and put in a full application to get a conditional approval, and then that has to go through another process to get an unconditional approval, and then it goes through settlement. This can sometimes take 9 months for a mortgage broker.
Yeah.
So, and I know that brokers are not incentivized by, look, they need to earn a crust, and the commission is how they earn their bread and butter, but the commissions are all so similar. We're not talking about lender A will give 2% and lender B gives 5%, or lender A gives 0.5% and lender B gives 1%. The band is so narrow, it really isn't. In financial planning, you've got commissions all over the place from different, let me tell you, in mortgages and mortgage broking, they are so slim, it makes no difference.
Yeah,
most brokers don't even know what the difference is.
Well, it's hair splitting. It is hair splitting, and if we're really talking about, for me, again, as a person looking from the outside in, fully applaud a Royal Commission that's going to address misconduct, and fully applaud anything that's going to improve consumer outcomes, that's going to look at the conduct of people in the industry, and is going to promote and maintain as much competition as there is, so I'm getting a very cost-effective result. 100% behind that. I guess the massive gap between that and the recommendations, though, doesn't make any sense, because from where I sit, what the Royal Commission has allowed the big banks to do is throw a grenade to deflect attention onto brokers who are, over 80, nearly 80% of us are one-man bands. So we're a very small industry that doesn't have a lot of teeth or resources. And for the Royal Commission then to say, right, one of our major ploys is to move to a user pays exercise. So rather than the banks pay the broker, the consumer has to pay for it. Then what it's very neatly done is allowed the big banks, and let's not hold back. Commonwealth Bank, the CEO was very forthright and his anti-opinions around brokers, and mainly because the Commonwealth Bank has the most to lose. Their market share's been gone from, I think it was over 50% at one stage. Alex, you'd know better than I will.
Yeah, that's right. Look, Bushy, I mean, at the end of the day, I'm very passionate about this because, again, for me as a borrower, if I ended up in a situation where I was in 1998, running around the bank, with my hair falling out, it's all fallen out now nearly, but anyway, that was years ago. But literally, running around the banks in a blind panic, like scared for my life that I wasn't going to be alone. The thought of going back to that just terrifies me for other Australians, for young people coming up in the marketplace. But at the end of the day, for the banks, it's just business. The CBA, it is just business. They have looked at their erosion of their market share to date, and it's easy to do the maths to look at the equation of my survey reflects the fact that people are leaving bank branches just because brokers give them better outcomes. It's that simple, And CBA has been able to work out what the impact on their market share will be with a very expensive branch network over the next 5 years if brokers continue to take the same share. And they will lose probably 5% of the market if that continues. So it's just business. And they've gone, we've got to do something about this. And the Royal Commission is the perfect backdrop to put a very tangible plea to go, well, look, we will operate in the best interest of Australians. We believe that a borrower pays fee is the right structure, and it's so plausible. The fact is, it's absolutely inaccurate. And look, the Commonwealth Bank has been really critical for mortgage broking in the past. The Commonwealth Bank has excellent products. It has been, I looked at what the Commonwealth Bank, how the Commonwealth Bank supported mortgage broking. Ironically, in 2008, during the GFC, we were hit so hard. We were shielded in Australia, let me tell you, by, in terms of mortgage broking, by the Commonwealth Bank continued to lend. Now that was a time when, and there was a leadership there in third party. There was a lady called Kathy Cummings who was there as head of third party at that time, and she absolutely defended mortgage broking. She saw the value that brokers had, and at that particular critical time, she backed brokers and stayed in there. Now, that's because they saw the value in mortgage brokers and the outcomes they delivered. But I think the thing is now that that the mortgage broking market share has swung so far that now there's just a change in policy at Commonwealth Bank, and they're just going, look, this is now a threat to our market share, not a compliment. So Commonwealth Bank has been, it is just business, nothing personal. They have excellent products, and they have really backed Australian lending in times when we've really needed them to be in the marketplace, because other lenders have pulled out, almost completely back in 2008. And if you look globally, during the GFC, people just couldn't borrow. So, but right now, this has been a very cynical move. It's just business. It's just business, and they're looking to protect their market share. And
it's a great deflection. If you've got the mirror and you're deflecting attention onto someone else to take the heat off yourself, you can very easily become a wolf in sheep's clothing. Which is I take my hat off to the major banks in this exercise, because they very cleverly used the Royal Commission to potentially better their situation at the expense of consumers. And I guess my biggest concern is this, because let's join the dots. If the recommendations are fully implemented, then there will be a lot of brokers that leave the industry. A lot of the second-tier lenders will lose access to clientele, which pushes people back to the big banks, which means that rates will increase. So higher costs to people trying to get a home right across the line. And then the ongoing flow on from that is that higher costs means people will be able to borrow less, which means they'll have less to pay for the property, which means it will also ultimately affect property values. And this is something that I don't think people have twigged onto enough, because it's just a natural progression. We've said a couple of times already, property is a game of finance. So the less money you have to put into a property, the less property you can buy. That places
it just it excludes the thing that I love about property. I've got friends who, have fairly low income, but have been able to create a better future for themselves, for their family, for their kids, by being able to use leveraging, by competitively priced mortgage products, and being able to get in the marketplace. It's hard enough getting together a deposit. What will happen if we are not careful is you will end up, for a great many, hardworking Australians who maybe, are not in the higher income brackets. They're going to get excluded from home ownership first and foremost, from the opportunity to build wealth, through investment, and to have the opportunity to get ahead, and that really saddens me, to be quite honest. Should you lose that competition, there is, you can look at any graph to see, how the margins have come down since the 90s through the pressure that competition has put on the major banks. They've gone from a 5% margin down to about a 2% margin. That's 3% back to borrowers. That is critical. That's significant.
Massive. That's 60% drop. That's a massive drop in margin. And I can't say enough again that it's not. Forget the mortgage brokers. They're the pimple on the pumpkin. The pumpkin is the impact that's going to have on every Australian's potential home value, because of the lack of ability to get your hands on the money. And I guess that for me, there's an urgency around this, in that we've got a very limited window of opportunity for the average homeowner to start making some noise, because we've got an election between now and the end of May. Politicians are making up their minds right now as we speak. Perhaps share with us where each side of politics is currently thinking around this, and then most importantly, what I'm keen to wrap up this part of the discussion on is, what can people do now to try and make a difference, Alex?
Yeah, absolutely. So, just first of all, I haven't been dealing. I'm not a lobbyist. I'm not a political animal. I've just gone and done the research. But from what I understand, so the coalition will so both sides of politics have now said that the only thing that they're not going to accept in terms of the recommendation is that we go to a client fee model. Now, both sides of politics have said that they will not switch to that. But right now, as things stand, both sides of politics have said that in mid 2020, the deferred part of the commission, i.e. the trailing commission, will be scrapped. So that is what has been said at the moment by the coalition. Haven't stated on that, but Labour have said that they will implement that. This is the proposal, incidentally, from the Royal Commission, is that Trail Commission goes mid 2020, June 2020, and then 3 years later there is a review of upfront commissions. So the coalition has not made any comment whatsoever. Labour has said that trail commissions will go, but that upfront commissions will be changed to a flat level of a maximum of 1.1%, which kind of means that what they're doing in essence is they're saying they're going to kind of make up for the loss of trail by adding that to the upfront. The problem that I have with that, look, apart from, again, from mortgage brokers having the value of their business tied up in that trail, apart from the fact that mortgage brokers deal with their customers, on a regular basis with inquiries about an existing loan, and that remuneration, just that support for brokers isn't there. There is another angle to this, Bushy. What that means is the deferred payment helps smaller lenders operate in the mortgage broking marketplace, because paying out a 1.1% commission for smaller lenders, that's a lot of money for them to actually part with as a lump sum.
Yeah.
And it will impact competition. Let me say it's going to hurt brokers because they used to a marketplace where that kind of commission, the commission is deferred. There's less commission overall for the brokers. Let's be very clear on this. So 1.1 does not make up for the trail that's going to go.
No.
So there's less commission out there in total, but it's going to put pressure on smaller lenders because they've got to pay that up front, and it puts pressure on brokers because they're essentially working for less money.
Yeah.
So in terms of politics, this is just my opinion. This is very, very hot at the moment, or it certainly was a couple of weeks ago, because we'd endured, sort of many months of these, quite shocking reports that have come out by the Royal Commission of Australian farmers that have lost their property, of people, dead people being charged fees. Pretty abhorrent behaviour from the major institutions.
Sure.
So it's a very hot topic politically, and the politicians have wanted to get out there and say what they think. There is a part of me that believes that as this fades from the public eye, as long as Australians are aware, I think the first thing is you need to be educated, whether you're the customer of a broker or whether you're not, exactly how your choice and your access to finance is impacted. What needs to happen is that voters need to be aware of how how they will be impacted. I'm not saying that this should influence whether you vote one way or another. I'm not going to get into politics, but I think you need to make it be known that you are aware of exactly what the impacts are. There are a number of campaigns going out. I believe one of them is Broker Behind You. There are various petitions that are being circulated. And the last time I looked, there were many tens of thousands of just customers who are wanting to make their feelings known in terms of the impact.
Reading some of the advisor exercises over the last couple of days, I think there's 80,000 on the Don't Kill competition, and a very similar number on the Broker Behind You exercise.
That's right.
I guess my feeling is not so much about the vote, it's more about we've got from now until the election for everyday hardworking Aussies with the home loan to be bashing down the doors of every politician saying, hey, don't let this go through, because it's going to affect my children, it's going to affect the value of my home, because if we're not talking to them and we're not making that presence right across the board, then we deserve to get what we get. I've always been of the belief, mate, when the time is right, you make a noise, and if you don't, then suffer the consequences. And for me, we've got eight weeks, essentially, to be bashing down the doors of the politicians saying, hey, you had a Royal Commission that supposedly was going to give us better outcomes for us, that was going to sort out the conduct, it's going to improve the competition, and what you've actually just done is put dirty gate crosses against every one of those.
It does not favour the Australian borrower. You know what? You will get probably, the banks will lend a similar volume of money out, but you know what? It'll be on their terms. And you've got to look at the equilibrium. Banks want to lend in terms that favour them, i.e. with the highest possible lump of fat on top for them, with the policy that's just the easiest for them to consider, for assets which are a no-brainer. On the other side of the seesaw, you've got people who can only afford to buy what they can afford to buy, but they need flexibility in terms of lending. And by flexibility, I just mean, you have to have lenders that will help self-employed borrowers, people setting up in, people who are running their own business or want to set up a business. I'm a business owner, and I've gone through all this as a business owner. Yeah. It is really tough, let me tell you. I work hard. I employ now 130 staff. I pay significant money back into the economy through the taxes that I pay, through GST, through everything else. But for me as a business owner, it's very hard to borrow money. There are a lot of people who are going to not be able to access finance if we lose competition. And competition, the brokers are the guardian of competition in this country, and it is really critical. Everyone has a responsibility to be educated and to let their feelings be known, because everyone will suffer. That is my absolute belief, and it's certainly what the research tells me.
Yeah, and sort of backing that up, I think the take-home messages for all the listeners out there are jump online and sign the petitions that are active in social media. There's Don't Kill Competition, and there's Broker behind you. If you just Google those words, then jump on, send an email, or on one of those sites is actually pre-written emails to all the MPs on every side of the fence. So make sure all you got to do is tick the box and it flicks that to them so that they're getting barraged with this. The other thing that I'd be suggesting people do, Alex, is that over the last couple of years, there's been a national group that's formed called the Property Investors Council of Australia, and it's, you don't have to be a property investor to be part of it. You can be interested in property investment, but the aim of that group, which has been driven very strongly by Ben Kingsley, who you know quite well.
I do. I did a joint podcast with Ben. Yeah. Just a week or so ago, talking about the same stuff. Yeah.
Same stuff.
He's done a great job.
I'm driving the picker exercise here in South Australia.
Fantastic.
And
get behind it.
Well, there's just on the mum and dad investors, there's 2.2 million of us here in Australia. If we all got together, and it's $5 a year to be on board with Picker, so we want people on board. So we've actually got a unified group that's looking after the interests of average property owners that can lobby banks and governments to start representing the views of the people on the ground, mate. So very strongly encourage anyone listening to jump onto Picker. It's www.pica.asn.au. Pay your $5, and if we can get enough people together, then anyone in the political or bank arena is going to have to start listening to us, because then we've got a unified voice to do so.
Yeah, so, get behind.
Mate, that's been awesome. You've really covered off some great ground there. I am going to flick us straight into the infamous ambush bushfire lightning round, mate, which is 5 very quick questions that I ask of everyone that comes on the podcast, and they're questions that the audience keeps asking me, and so I'm going to jump straight into that, mate. Your favourite quote and why? What would that be?
There are many. Probably one of the ones that resonates with me is comparison is the thief of joy. And I think that really rings true in so many things. When you start to compare yourself to other people, I think, whether it's in happiness, finance, where you are in your career, I think it's a real negative rather than a positive. I think be the best that you can be, do the best that you can do, and focus on conducting yourself in a way that that you feel proud of. Striving to achieve the goals that matter to you, not necessarily that are sort of pegged against what other people have achieved in life.
Yeah, love it. Yeah, absolutely perfect. And rolling straight on from there, and I'm going to we'll open up this one a little bit. What's both the top book and the top podcast that you would recommend people have a listen to?
And outside of yours, I would say in terms of a book that really had an impact on me. And again, look, I'm a salesman by trade, or at least I fell into sales in my 30s. I won't bore you with the rest of the details of my earlier life, but How to Win Friends and Influence People is not just a really good guide to better understand people and therefore be more effective salesman in terms of creating the right outcomes. And I think, whether you're a husband, a wife, son, a daughter, a business partner, an employee, an employer, that really, I think, is, for me, and there are many great books out there, but that for me, I think, is really a good guiding light in terms of how to sort of conduct yourself in a decent way through life.
Totally agree, mate. Dale Carnegie classic. It changed my life, mate. I read it, would have been 35 years ago, and it was written way back in, I think, the 1920s, I think, from memory.
Absolutely.
And it's still relevant today, and it's actually a manual on how to conduct yourself in life. There's no doubt about it. You follow those age-old principles, and you're going to do well in whatever you're doing. So, absolutely cracker, mate. What about a podcast you suggest people have a listen to, apart from smart property investment?
I've got a bit left of field here. Look, I really like Ben Kingsley's podcast, The Property Couch. I think he is very, very informed. He's very curious, and he's very passionate about helping people, understand where they're going. He's not a spruiker of anything in particular. He's just somebody who wants to share experience, knowledge, and help people make better decisions. So from that perspective, that's a good one.
Yeah.
I'm going to be very left of field. There is a podcast that I really like, which is called Jocko Podcast. Jocko is he was a Navy SEAL. A US Marine. It is very much. So he will do reviews of books written about from military, sometimes from foot soldiers, sometimes from commanders, from going back to the Napoleonic Wars right the way through to Second World War through to Iraq. And I personally find that really very revealing in terms of traits of leadership. People who've endured incredible hardship, people who've behaved with great courage in extraordinary circumstances. It's not going to be everyone's cup of tea, but I personally quite like that. It's a bit.
That's a cracker. I think Tim Ferriss interviewed Jocko, and
he's been on. Yeah, Tim Ferriss has been on there as well. He's joined Jocko on that podcast. So
I think it was Jocko who said that freedom equals discipline. Which is one of the quotes that I live by. I think it's just absolutely nails it, mate. Now, awesome. Now, moving back into the investment sphere then,
yes.
What's both the worst and the best piece of investment advice that you've ever received, Alex?
The worst bit of investment advice. The worst bit of investment advice I ever got was when I very first started investing in Hong Kong, and before I bought property, and I was told that there was a Hong Kong fund manager called Peregrine, which was looking like it was going to go bust. And I was told there was a ramping rumour that went round that BNP Paribas was going to buy it out. And I went down and I bought several $1,000s worth of shares, gambling, being greedy, believing that this rumour was going to come into fruition and I was going to quadruple my money. Let me tell you. Uninformed decisions, without responsibility, with greed, and I touched on greed way earlier in this. That's greed. That was not an informed investment decision. It was greed. It was, hang on a second, I'm going to gamble, and then of course they went bust, and I lost everything. I lost several £1,000s. It wasn't a small amount of money to me back then. It put a big dent in my first deposit. That was the worst investment advice I ever had. The best investment advice. You know what? I think some of the best investment advice that I've had, your instincts and do your research. I think having confidence in your own decisions is really, really important. I think backing yourself, not, as I say, by taking a wild swipe in the dark and hoping that you're going to come out on top, having that sort of real, trusting in the force type thing, but going away, doing your own research, quantifying your own research and having faith in your own decisions, I think is probably the best advice that I was ever given early doors. I think also advice, again, I look back at when I bought my first properties with Central Equity. The guys there were really very inspirational for me. Look, would I buy off-the-plan stuff in the future? Look, no. But the fundamentals of what they taught me to take a long-term view, not to look at making a quick dollar. They taught me, they taught me the power of capital growth, and they taught me the power of leveraging. So I think understanding really the potency of leveraging in the long term is really, really valuable. When the penny drops around, taking your time and letting capital appreciation with leveraging work its magic, then that was the most fundamental thing for me.
Yeah, brilliant. They're time-honoured principles, those, there's no question about it. Mate, what about a personal habit that contributes to your investment success? Personal
habit? That's a difficult one. I think this is a habit. Look, some of the habits that I do, I keep myself fit. I don't necessarily eat what I ought to eat all the time, but I do balance that out with either swimming, running, going to the gym. So I keep myself fit, and if I keep myself fit, I find I keep myself mentally agile. Yeah. But I also, Bushy, I try and not remain static in terms of the way that I view the world. I try to. I'm very thoughtful about where I'm going. I'm very thoughtful about wealth, about how much I need, how much I really want, and exactly why I want wealth. And by wealth I don't mean it could be $100, could be $1,000, could be $1 million. It's relative to every single person. But understanding where I'm going and why I'm going, and how investments relate and can translate to happiness, to balance with your loved ones, with your family, with your friends. So I think trying to remain nimble in terms of the way you think is very, very important, and keeping yourself fit and keeping yourself agile. Yeah, sage advice there, mate. Again, simple things that a lot of people just don't make time for and pay the price later on. So awesome, mate. Now, just to bring it to a close, mate, you've been extremely generous with your time, mate, and some very informative around some hot subjects that are people really need to be thinking about now. But what's next new and exciting for you and the Momentum team, mate? So, for me, it might not be very exciting for everybody else, but I'm just in the throes of conducting a significant research project looking into satisfaction with lenders across the board. So, from smallest through the largest. So I find this fascinating. We've done this for 10 years, and it's really, really. And again, look, just quickly harking back to mortgage brokers. So I've mapped why brokers choose particular lenders over the last decade. And I can tell you now that the reasons, and this is long before remuneration was brought into the question, it is they will choose a lender based on turnaround times, policy, and the interest rate on the loan. They're the factors. So it's going to be. I'm really looking forward to getting into this. It's an old friend, this particular research project, and every time we go in, we get about 1,000 brokers give their feedback on that. So, look, very nerdy, but that's what I'm looking forward to doing next. And, mate, if anyone wants to get in touch with you or the Momentum team or all of those various outlets through Smart Property Investment, how do they do that? I have to say, look, forever, thank you so much for listening to me for so long. I'm humbled and honoured that you've listened to me talking. Look, whatever area you're in, we publish for accountants, lawyers, financial planners, real estate agents, as well as property investors, people looking to build wealth. We've got significant publication, we've got the major publication in the defence industry. We've also now moved into space, looking at space in the Australian space industry. So, look, we publish for professionals. Check out our publications. We've also got, my business, and check out the Momentum Media website if you want to see if your particular profession is catered for. And if you ever want to get in touch with me, you can reach me through Momentum Media or Momentum Intelligence. Terrific, mate. Look, you drive some fantastic publications, and you drive some fantastic events around industry as well that recognise high-performing people in all of those spheres. But what I love about what you're doing with Momentum is that you're drawing the needle through all of those, so that as a holistic overview of what's happening right across the market, there's no better person to talk to, and that's the very reason why we've enjoyed having your company on Get Invested today, mate. So I really appreciate your time. It really has been an absolute pleasure. Thank you so much for inviting me on, and hey, look, maybe let's get you across and have a chat with you on one of our podcasts soon. That'd be good. Would love to, mate. Appreciate your time, mate.
We'll talk soon.
Thanks for having me on. Thanks for listening.
Well, freedom fighters, how good was that? To get a summary of all this investment gold in the show notes, just email me on hello@khgroup.com.au. That's hello@khgroup.com.au. Or check us out at www.bushymartin.com.au/get-invested. I look forward to joining you next week for another episode of the Get Invested podcast. So thanks for listening, and as always, dream as if you live forever and live as if you'll die tomorrow.